From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny in for Jonathan Farrow. So with a little green on this screen, it is the best quarterly earnings beat since the end of 2021. Can we top out on these equity markets? Countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up in the show, futures trying to rebound with more Fed speak on tap. Earnings from Macy's and Lowe's offer fresh clues on the consumer, and the G20 sees a growing chance of a soft landing in the global economy. We begin with a big issue. Will this rally top out or broaden out?
I think we're going to see a broadening out.
Broadening out of earnings growth.
So it may not.
Let's not get carried away.
The market is narrow.
The difference in earnings growth of technology and the rest of the market, the difference is likely to shrink.
And you are seeing a broadening out to other parts of the large cap universe.
And we're starting to see it in industrials, healthcare, and financials.
Growth in technology stocks starting to slow down somewhat.
The Magnificent Seven has turned into the Feisty Five.
The equity market's sort of really nicely sort of set up from here.
The uptrend is intact.
We do see in that Goldilocks scenario some quite substantial upside still to come.
That is a good narrative for a healthy bull market.
This has been a narrow rally, and I certainly hope it broadens out.
Joining me now to discuss the broadening out or topping out, it is my guest this morning from iCapital, Anastasia Amoroso, and Colin Martin from Charles Schwab. Anastasia, good morning. Broaden or top out?
Broaden. I'm definitely in the broaden camp. And the first thing I'll say, Manus, is that I think stocks do have staying power broadly. The reason I say that is because there's this sense that economic enthusiasm is actually picking up. And even though we pushed off the Federal Reserve rate cuts, if you look at the data, whether it's the consumer, whether it's the manufacturing sector, we're starting to see more and more positive momentum. I mean, just this morning, case in point, capital goods orders, excluding defense and aircraft, were actually a positive surprise. So we see more data points like that supporting GDP and therefore supporting stocks. But then to the second point is, I think stocks have staying power and the participation should be more broad. I do agree with some of the comments we've heard from, for example, Jay Woods, that we are seeing tangible signs that industrials are starting to perform, transports are starting to perform, equal weight S&P and small caps are also participating in this rally. So I think there is absolutely a sense of broadening out.
Yeah, I mean, there is a sense of euphoria. We'll come to that in just a moment. Colin, good morning to you. A sense of euphoria in the equity markets, and you look at the bond markets, again, struggling to find significant caps against rising yields. Give me your first take in terms of the equity euphoria, how that translates to the bond market.
Manus, well, we're not actually seeing it as much in the Treasury market. We're seeing yields up, of course, but they're not surging, and we're not quite yet at the peaks we saw last fall. But we are seeing it in the credit markets. If you look at year-to-date excess returns, basically the lower the credit rating, the higher the excess return. We're seeing credit spreads continue to fall. If you look at high-yield spreads, they fell again yesterday, and we're at levels in both investment grade and high yield that we haven't seen in 2 years or more. So we're seeing a lot of euphoria there, despite the fact that defaults continue to rise, despite the fact that borrowing costs are still high, which is a challenge for issuers. But then if you look at the new issue market, we aren't seeing any issues there. We're seeing back-to-back months of record-setting issuance. It's probably not going to continue given how strong we saw March and the following months back in 2020. But there's a lot of demand out there. Investors want to buy corporate bonds, both investment grade and high yield. And if you're an issuer, it's very attractive right now. Treasury yields are off their highs, and what they care more about is the spread. And if you can get the lowest spreads you've seen in a couple of years, that's an attractive market. So we are seeing signs of euphoria there. We're a little concerned, though, that there's just not much further to go because those credit spreads, both in IG and high yield, are near their cyclical lows.
It's whether we've got a level of exhaustion and whether they pick up these yields duration here. And Stacey, can I just get your reflection on this? This is what HSBC, I mean, this is a moment when a strategist really feels the pain. We cut our overweight stance in global equities and high yield credit to underweight in early January. There's no beating around the bush. We got it wrong. My question and my extrapolation from this, I want to get a sense from you. Is there a feeling, is there momentum of a capitulation? Do you sense that we're at some kind of a capitulatory moment where the equity bears are beaten back?
I think so, Manus. And one measure to look at is, for example, how many analysts out there are forecasting recession. And this time last year, something like 80% of economists were forecasting a recession. And today that number is 0 or, negative, if that's possible. So I do think that the bears have started to capitulate. And I think what's been really surprising to some market participants is that on the one hand, you look at technical indicators and you say, wow, this market is really overbought. And if you look at investor positioning, for example, of some of the systematic traders, they're, close to records in terms of net longs. You look at hedge funds, they have been chasing as well. So you ask, well, how much more can there be? How much more can the market continue to stay higher? And I think the answer to that has to do with the rest of the market infrastructure, with the rest of the retail investors, mutual fund managers that are turning more bullish and have lots of cash to put to work. So I think that's been the rebalancing power that's been keeping the market afloat, is retail investors stepping in, hedge funds rebalancing into cyclical stocks, and also mutual funds that, the same ones that forecasted a high probability of recession now pivoting and increasing their equity exposure right now.
Yeah, and this is about U.S. exceptionalism from the dollar to equities. But, of course, we're going to have fresh U.S. economic data. We had it a little bit earlier this morning. We're going to have more throughout the week. It's going to be a battle of the data. Mike McKee is going to be busy. He's with me now. Mike, good morning. We just had a little bit of data come across the tape. We've also got a bit of Fed speak to absorb. We've got a new Fed voice in the past 24 hours. We're beginning to understand what he thinks. Take me through the nuances.
Well, a lot going on, and you guys are kind of optimistic this morning, so who am I to pop the bubble? We just got durable goods at 8:30, and it was bad news, but really just bad news for Boeing shares, I guess, because durable goods orders were down 6.1%, but that was because Boeing fell, its non-defense aircraft orders fell 58.9%. Capital goods orders, ex-defense, ex-aircraft rose 0.1%. That's what Anastasia was talking about. That's basically what business spending is. And shipments rose 0.8%, which gives us a fairly strong start to the first quarter in terms of business spending. You take a look at durable goods, and I just want to show you this chart here because the economists don't pay a whole lot of attention to durable goods other than in a general sense because it is so volatile. The headline numbers so affected by Boeing. That's the white there. That's dollar value of what Boeing's done. And then the blue line is durable goods orders. And you can see as Boeing goes, so goes the durable goods headline. We did get a couple of other data points here. The FA House Price Index up 0.1%, S&P CoreLogic 20 City up 0.2%. So home prices still rising. And now we have, as you mentioned, the maiden voyage, the first speech by Jeffrey Schmidt, the new Kansas City Fed president, who aligns himself firmly in the hawk camp, saying that with inflation above target, labor markets tight, and demand showing considerable momentum, my own view is there's no need to preemptively adjust the stance of policy, so not in a hurry to lower rates. Now, he did go on to add one thing that not a lot of them have expressed an opinion on. He is ready to get rid of the balance sheet, basically to continue getting it down as much as possible. It should be a priority, he said, for the Fed to reduce its balance sheet and lessen its footprint in financial markets. We know they're going to be talking about it at the March meeting, Manus, so here's a voice that's going to be pushing in that direction.
Oh, can we survive without the central banks, all of them be involved in our markets just to create dirty confusion? Mike, thank you very much. Mike McKee there with the very latest on the data and what is to come. Anastasia Amoroso and Colin Martin are my guests this morning. Colin, to you first of all, we had a record 5-year auction yesterday, but they couldn't get it away without a little bit of moderate coughing, if you allow the pun. I mean, it was bid to cover, one standard deviation below the average over the past year. I mean, it's tiny. It's not what you call unseating of the bond supply. But how do you think this bond market is set up? Because it's going to hit again and again and again with more supply.
It could be an issue in the next few weeks. We're looking at auctions that we've never seen before. Multiple tenors in tens of billions of dollars. And as you alluded to yesterday, it wasn't the best auction. But when you looked at the market response to that, it's not like we saw too much concern in terms of a yield spike or something like that. When we look at Treasury auctions, we think there's kind of a marginal effect there, but it's not something that drives our views. I mean, you might see some swings here and there, but when we look at our long-term approach to where Treasury yields are going and how we think our investors should be positioned, we're focusing more on growth and inflation expectations and Fed policy than each weekly Treasury auction. So again, on the margin, it might make a few basis points here and there, but it's not something that we're focusing on too much.
Yeah, I had a guest this morning, MUFG. We were talking about Bank of Japan, and we were talking about the strength of the dollar, and he said the uniqueness of U.S. assets at the moment may well reflect on the debt pile at some stage later, and it could take a weaker dollar to actually cause us to still want to hold U.S. assets. But Anastasia, we talked about this stronger dollar. It's had an exceptional run. It is U.S. exceptionalism. To what extent does that morph itself into that strong dollar? Does that have any headwind for equity at any stage?
Well, I think it's an incremental headwind, but one that's sort of being concurrently priced in as the dollar strength continues. I mean, if you think about the S&P 500 exposure, depending on the sector, 30-40% of that is revenues that are being generated outside of the U.S. And of course, stronger dollar would be a headwind to that. But when you think about what does it take to move the needle on earnings per share for the S&P, it really takes a sizable move higher, let's say 10%, to reduce the earnings growth by 2 or 3 percentage points. So I think we're not at that stage. And also the other thing I would say is there are also offsets against that, which is just stronger growth in the U.S. and elsewhere. We talked about the U.S. consumer resilience, the U.S. economy resilience, but I actually do also have a more optimistic view outside of the United States as well. And for example, as challenging as it has been for the European consumer, I do think it gets better this year because real incomes are supposed to grow at a faster clip. And also you don't have the same energy challenges, and you are likely past the peak in interest rates and therefore past the peak in mortgage rate adjustments for a lot of the European consumers. So I think that more solid demand could potentially offset any sort of dollar strength that would otherwise weigh on earnings.
Anastasia, I welcome a global perspective every morning at 9:12 a.m. on this show. We might even get you a Japanese call out of you in just a moment. Don't worry, Colin. I don't need an opinion on JGBs from you. Team 9 a.m. Stay with us. Let's look under the hood. The stocks that are moving ahead of the bell. Abigail Doolittle is with me. Abby.
Manus, the crypto rally, it absolutely is continuing this morning with the shares of crypto-related stocks going higher as Bitcoin is now at 57,000, the highest level since November of 2021, up 144% over the last year. And it's so interesting because, of course, MicroStrategy, it's a software company that buys Bitcoin and was a principal trader, but you can see those shares rallying in a big way with Bitcoin up about 10%. Zoom up about 8%. They beat top and bottom line estimates with a nice billings beat. There was an impressive forecast offered, and the board has approved a buyback. Lowe's down about 1.7%. Comp sales for the year are still forecasted at down 2 to 3% as the DIY market stays muted. And this is a little bit more than investors and analysts had estimated. And then we do have some breaking news. SunPower, their CEO, Peter Farsi, has stepped down. The stock reacted to the downside on this news. Right now, they are putting in place a temporary CEO, Tom Werner, and they are starting a comprehensive search for a new CEO. That stock down again in reaction.
Sudden succession planning. Abby, thank you very much. Coming up in the show, retailers offer fresh insight to the hallowed U.S. consumer.
The customer is evolving. They're getting younger.
And, it's really a lot of competition to get people off the couch and into a shopping center. So you can't just use great creative marketing to get a younger customer to come to your centers. You have to have the brands that they like.
Brand loyalty. We take a look at this morning's retail earnings. That's next on Bloomberg.
It's interesting, all the different places where one can shop online or large department stores. I think there's nothing more satisfying to a customer that when a service representative says, you look pretty good in that thing.
Consumers in focus. The retailers post their latest results. Lowe's under pressure, forecasting a decline in annual sales. Macy's delivering a tepid outlook, and 19 plans to close a third of their U.S. locations. The CEO highlighting the challenging environment that we're in, saying, quote, the shopper is still under pressure. Inflation is still up. Simone Foxman joins me now with the breakdown on the numbers. Simone, first take.
Yeah, Manus, both of these major big box retailers offering weaker than anticipated guidance despite a fourth quarter for both ending in early February that was a little better than most had anticipated. Macy's outlining its bold new chapter as it faces activists. Essentially, the idea is go out and monetize some of these real estate assets. It's going to close 150 of its namesake stores, believes that's going to free up between 750 million. It is going to take about a 50 million charge on laying off employees. Also going to add some of those higher end consumer names, those Bloomingdale's, those Blue Mercury stores, the tune of 45 of them. But overall, its guidance is weak and lower than last year. Lowe's also having pretty weak guidance, but that's not really surprising the street, especially after what we heard from Home Depot. Fourth quarter comparable sales were down 6%, but that was actually better than anticipated. But for the year, still looking at declines of 2 to 3%, worse than the 1% that had been anticipated. CEO Marvin Ellison talking about continued pullback in DIY spending, especially with mortgage rates above 7% and higher than we had seen in late December and January. However, D.A. Davidson saying we would rather see Lowe's guide to something makeable than set a high bar and have to revise guidance down. So maybe everyone just setting low expectations as they look ahead to this fiscal year, Manus.
Oh, you can't beat the old playbook, can you, Simone? Guide low and deliver triumph. Simone Foxman there on the retail results. My guests this morning are Anastasia Amoroso and Colin Martin back with me. Anastasia, let me come straight to you. Banking on the hallowed high-end consumer luxury, that's the sort of the alpha of Macy's reconstruction story. From the research that you've done with the consumer, UBS have the hedonism of the US consumer. To you, how strong, how robust is the US consumer? Because we're fighting firm even with higher mortgage rates, aren't we?
Yeah, I think the aggregate story is the U.S. consumer is still very much strong with jobs market that is very strong and wages that are continuing to grow. But I think the more interesting story to us is this convergence of the low income and the high income consumer. We all know that for the last year or so, it's the high income consumer that really helped support the economy because they benefited from higher interest rates and, having that extra source of income. They benefited from a real disposable income that was growing at a faster clip than it was for the lower income cohort. But if you look for the projections for this year, first of all, we expect the gasoline prices to stay range bound as oil stays range bound. So that benefits the low income consumer. And the second really key important driver is that the real disposable income should start to be positive in year over year terms and sort of close the gap for the low income consumer with the high income consumer in terms of that wage growth. So that's really important because it supports consumption. And I think it also can mean that consumption is becoming more broad based. So whereas before you kind of go with the strength of the high income consumer, I think now what we can say is consumer in aggregate, broad based, should be supporting discretionary spending.
Well, let's take that baton and run with it, Colin, because I want to see whether you think that underpins the soft landing narrative, which leaves sticky inflation, which has got a consequence for rates and for bonds. Do you concur with Anastasia in the principle of this perhaps soft landing narrative that she's just outlined from the rise of perhaps the lower or less well-off consumer?
Yeah, we generally agree with Anastasia's point. She made a lot of great points in there. One thing that we're looking at, there's a lot of headlines about, the pandemic savings and what's left there. And I think there's a lot of numbers that get thrown out. I think what matters more is just the labor market, because even if you have savings, what probably matters more is, am I getting that weekly, biweekly, monthly paycheck? And we're still seeing the unemployment rate very low. We're still seeing a relatively healthy labor market, and that's supporting spending right now. Now, we do have some concerns, though, in terms of credit. We're seeing consumer credit continue to rise, although it slowed down a little bit at the last release. That's obviously a problem in a high rate environment, and especially a higher for longer environment, which we appear to be in right now, as we continue to see these rate cuts get pushed back a little bit, both in timing and the magnitude. So I think the Fed's going to be paying attention there. If we do see continued consumer strength, that can lead to inflation. I wouldn't say sticky in that we're going to get back to 4 or 5% levels, but maybe it's just a slower disinflationary trend if that continues. But that in and of itself, if the Fed postpones those rate cuts, that can have negative impacts, given all the credit that we're seeing out there.
Colin, briefly, we're counting down to PCE, which will be the definitive risk event of the week, I think. To what extent, and I'm asking all the bond guests this, to what extent do you think PPI, hotter PPI and CPI are already imbued into a bond price, a bond yield, I should say, at 4.29?
I think a lot of it's already in there, Manus. I mean, we got both of those reports. We've seen a really strong response in the Treasury market. Now, that doesn't mean we can't see another response. If PCE were to come in hotter than expected, I think that would spook the markets a little bit. But I think a lot of that is already priced in. If you look at PCE, we're trying not to focus on just 1 month. I mean, obviously, we saw a hotter January with both the CPI and PPI.
Yep.
Leading up to that with PCE, the trend was lower. So we're going to be looking at it, but we're looking for a more sustained increase rather than just 1 month.
You're going to have a seat on that Fed table. They're looking at 3 months, 6 months. And of course, if that 6 months comes in above the 2% level, we all may be reflecting in the rearview mirror and go, 4.29? Ooh, that wasn't so bad. Anastasia, thank you very much. Anastasia Amoroso, Colin Martin. We're counting down to PCE and your morning calls later this morning, 9:23 a.m. in New York. And JP Morgan's Jack Manley joins me on why investors are going to have to work just a little bit harder for your money this year. No such thing as a bad thing as hard work. The earnings season is drawing to a close. Yes, retail is under a bit of pressure today, but you've got Tesla having a nice bounce, just up under 5%. S&P 500 up by 0.1%. Can that hold? We're counting down to the PC. Nasdaq up 0.2%. In terms of the quarterly earnings, it is the strongest since the fourth quarter of 2021, as I said to you. But we are in that earnings phase, and you got to deliver. There you go. We've got a couple of stocks for you that have also had some shifts. JP Morgan downgrades Domino's to neutral, recommending investors take profits. Next up, Citigroup opening an upside catalyst watch on American Eagle, expecting the retailer to deliver stronger than anticipated results. Lots of messages in my inbox this morning as we see a little bit of green on these equity markets, still above 5,000. It's not 1999. That is the view from Citi. They say that this is a stronger scenario. We're also hearing from our guests that there's an air of capitulation. Some of the shorts are finally being squeezed out, rolling over to strong economy. You got pop groups at the Nasdaq this morning, De La Soul, so they're singing well and hard. Equities are rising. We have this overall momentum of where risk is almost euphoric. And the cross assets for you this morning, this is what we've got. We have euro dollar flat at 108. Yields popping just a pip or two higher this morning, 429. We'll see. We're counting down to PCE. It's already assumed that this is going to be probably a moderately hot print on the PCE on the 6-month trajectory. That's all in the price, according to my last guest. Crude up 0.4% at 77.94. All hail the moving consumer in China seems to be the narrative in the oil market. A better mobility post-Lunar New Year and a pretty strong Lunar New Year. Two stocks that we're watching, Macy's and Lowe's. This is on the retailer front. Reporting the numbers that disappointed investors. Katie Greifeld is with me. Macy's is on a big shake-up strategy restructure. And Lowe's, thank goodness I don't do home improvement yet.
Yeah, well, let's start with Macy's there, Manus. It's interesting here to watch the reaction in the stocks because originally you had shares down about 4% pre-market. As you can see, we're popping higher right now. And this is all about the turnaround plan here. I mean, if you take a look at the forecast, it was a little bit underwhelming. Net sales seen between $22.2 billion to $22.9 billion for the full year, the upper end of that range just below consensus. But the big headline, of course, this morning is that Macy's plans to shut about a third of its U.S. locations. That amounts to about 150 stores, which should free up as much as $750 million. Now, the company is instead going to add new Bloomingdale's and Bluemercury locations, really trying to focus on luxury. You can see shares really accelerating right now, currently up about more than 3%. So that's Macy's. You take a quick look at Lowe's here. The results largely seen as better than feared. Comp sales did fall in the fourth quarter, but slightly better than expected. Also calling for a dip of about 2 to 3% this year on comp sales. CEO Marvin Ellison's comments about the continued pullback in DIY spending has analysts thinking that it could disappoint, though. Specifically, D.A. Davidson wrote that we would rather see Lowe's guide to something makeable than set a high bar and need to guide down. But currently, you can see the shares shaking that off, currently about unchanged, slightly higher, Manus.
Okay, it's all about the strategy, whether you believe in it or not. Let's turn our attention to crypto. Bitcoin touched $57,000. Actually, we're trading through there now at the moment. And that's having a broad impact across the spectrum, including Marathon, Coinbase, and Riot. Abigail Doolittle is with me. 4-day rally, up 12%. Good morning, Abby.
Good morning, Manus. It is quite the rally for the crypto space. And we really have to start off with the crypto tokens themselves, in particular Bitcoin, as you were just mentioning, 57,000K, the highest level since December of 2021. Over the last year, up 143%. And I would say, based on the trading history that we have over the last few years, this signals a risk-on market tone. If you remember 2 years ago or so when people were saying that the VIX was broken, but look at Bitcoin, well, this crypto rally suggests, again, that there are animal spirits still out there, the digital gold not acting so haveny. So as for these crypto stocks, some of the pure plays are clearly up in a big way. Riot as a miner, Coinbase as an exchange. Now, the last quarter, this is interesting for Coinbase, very strong, and it had to do with these rising crypto prices and more activity. Up about 200%, these stocks, thereabouts, or a little bit more over the last year. But so, too, is MicroStrategy. I'm really fascinated by this one because I used to follow it, cover it back in, years ago when it was just a pure play software company. It is still a software company, but they invest in Bitcoin, so they're almost like a principal trader, too. It's a very interesting strategy. When we take a look at the technicals for Bitcoin, because that could be the future for these stocks, well, they stay strong. It is pretty extended over its 200-day moving average, saying that the long-term buyers are a little bit frothy, but the RSI momentum, it's climbing higher, suggesting maybe this rally has legs to it, at least for now, Manus.
Okay, there'll be a few people out there. Mike Novogratz, I'm sure, is one of them who'd be quite happy. Let's turn our attention back to the earnings. We got Zoom sales topping estimates and also announcing ever important $1.5 billion share buyback. We're paying to play on Zoom, Ed, and a buyback. What's not to love? This is about the enterprise side of the business as well, isn't it? Good morning.
Yeah, good morning. I mean, Zoom is Zoom in, and you're kind of right in the sense that this was Zoom showing some staying power with corporate customers in a pretty low bar quarter. So in the quarter gone, top line growth was in the low single digits. On the bottom line, there was some outperformance, EPS of $1.42 a share. The street was looking for $1.15. And if you zoom in on the enterprise customer, enterprise revenue grew almost 5%, but that's still viewed as modest for the period ending at the end of January. The corporate customers are there, and there is a smaller group, say 3,000 or so, that are spending big, accounts of $100,000 or more. The story, though, is that Zoom's kind of missed out on the rally we've seen in the last 12 months. They are trying to position themselves as more than just video conferencing, introducing a broader suite of functionality, call center assistance, and bringing AI into the story. I think I heard you say earlier in the show, Manus, that we are finally getting to the end of this earnings season. But if there is a common theme, sweeteners for investors have helped, and the $1.5 billion buyback is on the tail of $1 billion they did in 2022. I think that's probably a factor to the upside this morning.
Yeah, it's called the policy of appeasement, Ed. It's a very old foreign policy narrative from the Brits. Ed, thank you very much. Ed Ludlow in San Francisco. Let's turn to cruise lines. Norwegian expects a surprise profit for the current quarter after healthy consumer demand. Simone Foxman is with me. We're getting on ships. Simone, good morning.
We are, Manus, and that had been something that had been a question mark going into this earnings season. Frankly, we had question marks about tourism in general, especially with Expedia, laying off part of its workforce yesterday. But Norwegian shares, though they were down 20% year to date up until today, now up 14%, down just 9% for the year, really indicating smooth sailing on the way forward for Norwegian. Entered the year, according to the statement this morning, with all-time high booked position and pricing, and shares jumping the most since October on an intraday basis. It's guiding for the first quarter, as you said, ahead of expectations. Adjusted EBITDA expected to come in at $450 million versus expectations of $330 million. Guidance very good for the rest of the year as well, though it's a little bit more in line with analyst expectations. This despite the fact that it's canceled and redirected all ships to Israel during the fourth quarter and will do so for all of 2024. That would have been about 4% of all its capacity days. Bloomberg Intelligence saying pricing is robust, reflecting premium itineraries, mitigating the effect of higher dry dock costs and redeployment for the Middle East. Since only 20% of Americans have actually been on a cruise, Manus, they believe there's potential room for growth here. So full speed ahead for Norwegian, Manus.
There you go. Only 20%. That is really, really surprising to me. Simone, thank you very much. Simone Foxman on the cruise trail. JP Morgan's Jack Manley joins me now, remaining optimistic about the year ahead. 2024 should be another good year, but this time investors are going to have to work a little bit harder for their money. Oh, Jack, no, you're going to have to work a little bit harder to convince us of our money. Come on. So we're going to have to work hard for the year. So what, I have to have an imagination and go beyond the Magnificent Seven?
Believe it or not, Manus, that is how we're thinking about things right now. In 2023, I think we have to reflect on this idea that a year ago, nobody thought it was going to be easy, right? The story was interest rates continuing to rise, inflation still too hot, the consumer must surely be cooling off, the economy more broadly must surely be slowing down. Nobody thought we were going to see the returns that we did last year, and yet here we are, up over 30% from where we started 2023, driven overwhelmingly, to your point, by a very small handful of names. Now, I want to be very clear here. When I think about allocation in 2024, it is not about forgetting about the winners of last year. There are long-term secular drivers, structural supports for these names that will help them to continue to grow over the long run. What I am thinking about, though, is a broadening out of the recovery, particularly driven by earnings that are set to do a lot better for the rest of the index this year relative to last year. And investors are going to be tempted into those names by very reasonable valuations. I think this is very much a story of security selection, Manus. It's not about necessarily buying the index, although that may do well enough. It's about finding those individual securities, the sort of diamonds in the rough that are going to do well in today's backdrop, are priced appropriately, are generally speaking high quality.
Look, I know you can't dig into specific names, but sectorally, that robustness that you've just outlined really was tech last year. People said strong balance sheets, a lot of cash, generated cash, and therefore they did well, even in an upwind with interest rates. So sectorially, where are your diamonds in the rough, so to speak, in the breadth of 493?
There's nothing wrong with technology even today, Manus. I still like tech. I still like the tech adjacent names. I think this is one of those long-term secular trends, right? No one's going to argue with you that tech's going to be less important in a decade than it is right now. I also like the consumer names, particularly those staples, because we know the consumer keeps on spending, but they're having a little bit more trouble spending given what's going on with prices and, of course, with credit rates right now. Pockets of financials I can see, pockets of energy I can see. The net interest margin story for big banks is still quite attractive. Energy names becoming a great total return story. The parts of the market I'm not a big fan of, though, right now, Manus, are those bond proxies, because bonds are just doing pretty well right now. You don't have to get too creative outside of that fixed income space if you're looking for income. So, yes, we can have the sector conversation, but I do want to say once more that this is more than just sectors. It's certainly more than just styles. This is about those individual securities. We can look and find perhaps sectors that do a little bit better than others, but you're going to find high quality names across the market.
Just want to take a bit of a deviation and go global for a moment. We've been debating through the morning what happens next with the Bank of Japan, moving from negative interest rates potentially to positive interest rates because of the inflation, and the inflation consistently being ahead of the Bank of Japan's target. But I look at the equity markets, they're the highest in 30 odd years. I've got a number of houses here saying, look, this can continue. BlackRock and Amundi say, look, the stock market can power ahead in Japan. And you say this of the market, in terms of the rates and the timing of ripping the Band-Aid off those negative rates. Yes, I think it's true that March or April can be in play. That's going to be difficult to get the BOJ to toe the line on the back of 2 consecutive quarters, as you say, of negative GDP growth, weak private consumption, plus remarkably weak currency. So you see headwinds where others perhaps see halcyon days?
Well, I think you do have to draw a distinction between the macro backdrop and the equity market. I mean, these things are very rarely mirror images of one another. So just because the economy may not be doing particularly well doesn't mean that the equity market can't do well. I mean, we're seeing that play out right now, right, as we speak. The Nikkei hitting all-time highs for the first time in a very long time, while the economy seems to be lagging behind. I do think that the BOJ is going to feel comfortable moving interest rates from out of negative territory. I think they are going to have to be careful given some of those things that we just talked about, that slowing economy, but it's not going to stop them from trying to normalize policy. But a lot of these things are actually good news for the equity market. You know, inflation in Japan means that top line growth has been very good for corporations. It means that earnings growth has been quite robust because people are spending more money, and those numbers are typically quoted in nominal terms. The end of negative interest rates is particularly good for the Japanese financial sector, kind of like the European banks sort of getting left in the dust over the last 15 years, finally given their chance to perhaps have a seat at the table, at least to play the game with some of the other big high quality financial institutions out there. I can still be reasonably constructive on Japanese equities given some of the macro backdrop while being a little bit concerned about the overall health of the Japanese economy. I think you can square that circle.
Can we just square off back here in our home markets? I see Cathie Wood lightening up on TSMC, which is a global play in chips. You've got this huge momentum under the whole chip sector. When you see star investors or very well-known investors, depending on which way you look at this person, does that raise a flag about selling into strength, or does it say more about diversification and being nimble for this year?
I think the story is much more about diversification, much more about being nimble. I mean, we are very clearly in the early innings of what potentially may be a just transformative technological revolution.
Yeah.
I don't think it's going to happen over the next 6 to 12 months. I think we're really going to see the fruits of artificial intelligence in particular over the next 5, 10, 15 years and beyond. And I think if we are long-term investors, we have to harken back to the days of the early internet, when the makers of the internet, so to speak, those companies that were actually laying the literal pipelines to support the infrastructure, were the winners in the space. But you fast forward today, and the winners are very different. They're much more considered the takers, right? The ones that use that infrastructure to transform their business models or create entirely new business models. I think you're going to see something like that happen with artificial intelligence, where the tech makers, which would be those semi-producers at the moment, are doing quite well, fueling the development of this infrastructure. 10 to 15 years from now, Manus, it is very likely going to be a completely different ballgame. And I think investors have to be aware of that and properly diversify.
I am open to all robotic assistance in 10 to 15 years' time, Jack, when I'm on the beach, sur la plage, relaxing. Jack, thank you very much.
Sounds good.
I'll be in the metaverse. Coming up in 15 years' time, that is. Coming up, government shutdown. You forgot about that, didn't you? It's looming.
I think the odds we avoid a shutdown in the short term are pretty good. I think what ends up happening here is that they kick the can for a week or two.
Counting down the negotiations with Anne-Marie Hordarn on everything on Capitol Hill. This is Bloomberg.
I think the odds we avoid a shutdown in the short term are pretty good. I think what ends up happening here is that is that they kick the can for a week or two with some more temporary spending to try to work out problems. There's also the optics, even for the Republican purists who are charging a lot of this. But the bigger question is, this is going to bumble on for a month or more, with the idea that by April 30th, there are mandatory 1% cuts if they can't come to a deal. So those same Republicans think their leverage grows.
Terry Haynes there speaking earlier with Bloomberg about the politics of a looming shutdown deadline. Now, the government is facing a partial shutdown Friday. That's March the 1st. That comes just 1 week before a full shutdown, which would kick in on March the 8th. President Biden is set to meet with the top congressional leaders. The effort to pressure the House Speaker, Mike Johnson, and his Republican Party to make a deal. Anne-Marie Hordern is tracking all events on Capitol Hill. She joins me now. We write that it's the Speaker who they're trying to cajole Anne-Marie to do a deal. But actually, it's the long arm of Trump that they need to cajole, is it?
Well, look, there's a lot of individuals within the Republican Party, which Speaker Caucus's conference, that he needs to get in line to try to get a deal over the finish line. Because the issue, of course, is if he decides to work with the Democrats and keep the government open, the next big question comes. Will some of these issues and individuals in the far right of his party decide that they want to call a motion to vacate and try to get him out of his speakership job the same way they did to Speaker McCarthy? I think today will be an interesting meeting because potentially he'll be a bit more isolated. We know that Hakeem Jeffries, Senator McConnell, Senator Schumer, they all want to keep the government open. I think Speaker Johnson would also like to keep the government open. It's just the issue how he does it is there going to be the repercussions for him. But this is, remember, a partial government shutdown if we were to see one following Friday after midnight. The big issue would become March 8th. And Henrietta Treyz was on with us earlier, and she says there's an 80% chance that they would do some sort of deal and just kick the can down the road and have 2 new dates to look forward to for potential shutdown unless they get those 12 appropriation bills over the finish line.
But as you say to me yesterday, welcome to America. This is politics in America. 14 shutdowns since 1981, longest being 35 in 2018. I'm dangerous with a fact. But markets don't really sort of seem to care about this. But where they can very quickly pay attention is Biden, optimistic yesterday. His rhetoric was optimistic around the possibility of a ceasefire between Israel and Hamas. When could that happen? How real is that? This comes down to the coalition of the willing in France yesterday.
Well, so Biden said yesterday that he was thinking Monday, and he said that this is some of the information that's being given to by National Security Advisor Jake Sullivan. He also was speaking to Seth Meyers late night last night and said that what he was, the indications he got was potentially we'd have something by Ramadan. That's March 10. So potentially sometime between next Monday and Sunday, you could see a hostage negotiation. But I look at what Netanyahu has said over the weekend, which was that he says Hamas's claims are delusional. And until Hamas gets more in line, they would not want to forgo with an agreement. You have to remember, Biden's comments came just before today in Michigan. We have a primary vote for the Democratic Party. Now, yes, Biden is going to win this primary, but there's a lot of individuals that are going to go out and potentially vote uncontested. They do not want, they are voting this way potentially to send a message to the White House that they want to see more being done to protect Palestinians in Gaza.
OK, Anne-Marie, thank you very much for joining us. That's Anne-Marie Hordern with the very latest on Capitol Hill, counting down to a potential shutdown. Let's get your sector price action in under the hood. Abigail Doolittle is with me with, 22 minutes into the session. What have we got, Abby?
Interesting sector composition. We have the S&P 500 down slightly right now. The top sector, utilities, that is a defensive sector. Yields mixed, so those dividends may look a little bit more attractive to investors. Consumer discretionary, real estate up there. Tech is the worst sector on the day. Not a large decline, down 0.4%. But of course, there is a big weighting to the S&P 500 there. Let's take a look at a space that is really surging higher, though, and that is the biotech space. The overall biotech ETF on the day, last time I looked, up more than 2%, and it still is about that high. Viking Therapeutics up 66%. This is now a roughly $6 billion market cap company. And you guessed it, it has to do with the obesity drug results. They did a trial. I think it was a late stage trial, and it's pretty impressive. If we were to look at Eli Lilly and Novo Nordisk, we would actually see those shares down. So a new entrant, Manus, into these very popular obesity weight loss drugs.
Yeah, it's going to be a fiercely contested zone. It's going to be interesting to see where the pricing goes on that. Abby, thank you very much. Rounding up the sectors for you. I'll set your agenda for the rest of the week. And guess what? It's got a little bit of Fed speak in it. There you go. It's a beautiful day under the clouds in New York. Trading diary for you. What do you need to watch for the rest of the week? Consumer confidence data comes out at the top of the hour. The next team will bring that to you. Of course, it is about Fed speak. We are in full swing. Bostic, Collins and Williams. We'll hear from them today. Plus, we get the earnings from TJX and Salesforce. Thursday, pivotal piece of data. The Fed's preferred inflation gauge, PCE. And on Friday, the next potential government shutdown. We're counting down to that. Did you get that? Counting down to the shutdown. That was countdown to the open right here on Bloomberg. The retailers are delivering their numbers. Macy's is going for a full-scale restructuring, betting on the highlands of luxury to turn it around. Good morning from New York.